Good morning and welcome to The Open here on BNN Bloomberg. I'm Roger Peterson. Thank you for joining us. Let's get to some of the stories we are following in the BNN Bloomberg newsroom. Meta has agreed to buy Manus in a deal valued at $2 billion US. Manus is a popular Singapore-based artificial intelligence agent founded in China. The transaction marks a rare U.S. acquisition of an Asian tech company. A Meta spokesperson has said there will be no continuing Chinese ownership interests, and Manus AI will discontinue its services and operations in China. Frontera Energy has entered into a $120 million prepayment and commercial agreement with Chevron. The Calgary-based company will commit to deliver a portion of its crude oil production over the next 2 years to Chevron. Frontera says the agreement replaces an existing prepayment deal, which expires at the end of January. Tesla has published an average of analyst estimates for vehicle deliveries to its website. By Tesla's count, analysts on average expect a 15% drop in car deliveries in the fourth quarter when compared to last year. While Tesla compiles average delivery estimates, the company hasn't shared the figures on its website in the past. The car maker is on course for its second consecutive decline in annual vehicle sales. And taking a look at the markets, somewhat flat right now. We're awaiting the Fed's minutes from their meeting, and you can see it's pretty much a wash right now across the board. Taking a look at the TSX, it's in a bit of a little mini slump, I guess. It was off again yesterday, extending that losing streak. Still up near record territory, though. And, of course, gold, one of the ones everybody's talking about right now. Oh, we'll go to oil first and getting ahead of myself there. And you can see WTI is up right now, up above 58 as well after seeing some near 5-year lows just a couple of weeks ago. Still, though, for the year off by 17%. And now there's gold. Yeah, you can see it's back up over 4,400, up 1.4% after that dip yesterday. Silver also taking a hit yesterday, also bouncing back today. We'll be chatting about that in just a second. And the Canadian dollar, where does it stand right now? You can see it's off ever so slightly for the day, but up for the year more than 5%. Silver is having its shining moment in the market, topping $80 an ounce for the first time on Monday, floating around $75 this morning. Here to talk about the silver lining in today's market is Richard Arell, portfolio manager at R.N. Croft Financial Group. Richard, thank you very much for joining us.
Thanks for having me in, Roger.
I was saying this yesterday. I went away for a few days over Christmas, and silver, I was like, silver was how much? It's been an insane run.
Yeah, it hit about 80 US an ounce on Friday, I believe. Again, I was also partaking in family festivities, didn't have a chance to see it live. But his things pulled back a little bit and then bouncing again today. So very volatile market indeed.
And how do you navigate it? What's the best way? If you're in it or if you're looking to get in it, well, let's talk about if you're in it right now. How do you navigate this?
Yeah, if you're in it, it's been an incredible run.
Mm-hmm.
I think even 7 or 8 weeks ago, I was looking at prices around in the 40 US range, right? So
yeah, it's up by a third, I believe, in the last month.
Exactly. So when these types of events happen, we tend to look to take some profits, right? These are very spectacular moves very quickly. When they start to go parabolic like this, you're best to take a little bit off the table, because we've seen it. Obviously, it can reverse fairly quickly. Mm-hmm. This kind of taking the elevator up. The saying is kind of the escalator up and the elevator back down. So we want to make sure that people are locking in some of their profits.
How much should you be taking?
It's
a personal thing.
It's a personal thing, right? So if you came into the year with a lot of silver metals in your portfolio, then it's best to take some off the table. But even those investors who weren't directly invested in those instruments have been benefiting through exposure to the composite index, right? We've seen a pretty good year in Canada, 28%, driven mostly by metals, financials. So it's time to look, and annually is always a nice time to look at your portfolio, reposition it, make sure you've got the right objective and right asset mix going forward.
And what do you do with silver heading into 2026? If you say, if you don't have any in is it time to get in, or should you just sit on the sideline?
It's tough to chase. I find up here, it's tough to chase. There's an interesting piece of news that came out yesterday. So the CME Group, which runs a lot of the futures trading on silver, actually increased their margin requirements. So, there's lots of participants in that market. Some produce silver. Others, like maybe institutions or my firm, might be speculators in that market. We have no intention of delivering that silver. So they increased their margin requirement by about 13%. You have two options there. You can either sell some of your current holdings, or you can find some more cash to top up your margin, right? So, when those things happen, I've seen them before in oil, okay, back when it was $120, 20 years ago. It can start to kind of balance out that market a little bit and make sure people, okay, what am I holding? How much exposure do I have? And make sure you don't have too much in your portfolio.
Now, and it did seem to, but then it's almost back up to where it was.
Yes.
It dropped 9%, and now it's back up, I think, about 7 or 8%.
Yeah.
For the day. So is it going to take longer for that to kind of settle in by the CME?
No, I think those changes are effective, right? So they'll either look at portfolios or your brokerage account and make sure that you're on side. But it can just be a pause. I read an article actually on Bloomberg yesterday that there's a fund in China, a pure play silver fund, that is about trading at a 60% premium to net asset value. And so when those types of events happen, there's really a lot of, that's really froth or that fear of missing out taking hold in the market. You want to be careful because, there are firms out there that will take advantage of that. They'll find some type of pair trade to make sure that mean reverts back.
Well, here's somebody talking about that. There's a lot of paper out there there's more paper than silver out there.
Right. So every contract, going back to the CME Group, that you put up $25,000 US margin, but you're controlling a contract for 5,000 ounces of silver. So the notional value of that contract at $70 an ounce is about $350,000. So for $25,000, you're controlling an asset that's worth $350,000. That can be troublesome, right? That's leverage. That's what it is. And then, if firms have no intention of, fulfilling that obligation of those 5,000 ounces, they're speculating, right? So you got to make sure CME is trying to protect and make sure that market's orderly, make sure they have enough margin on both sides to make sure that everyone can settle and there's no problem. Again, the outlook for silver is fairly strong, but when I see this fear of missing out and that type of momentum going, I'm very cautious to get in.
And then others were gold, and then copper. Copper's another one that's gone through the roof.
Yes. So when CME makes these adjustments, they made it through a bunch of their different metals, because even platinum's had a great run as well. Copper is another good story. Okay, we've seen it decline a little bit back when there were some rumblings in the Trump administration about tariffs and stuff like that. But that chart still looks pretty productive. And again, Roger, they call it Dr. Copper, right? Yeah. The chart looks from bottom left to top right. I think that's pretty positive for markets going forward. You wouldn't expect that price behavior if the markets were going to head south quickly. Obviously, anything come up like a COVID type scenario. But barring something like that, looks pretty positive going forward.
And no concerns with the softening market in China, the manufacturing market. There was talk that's been softening a little, and
a little bit of concern, right? There's some consumer sentiment issues as well. I think we're looking for that more in the second half of 2026. We don't know, but you got to just have a plan for it. And that's what we talk to our clients about, is make sure your asset allocation is right now. And if the market conditions change, we have a plan.
And what about miners and things like that? What do we do? Where do you go with that when it comes to silver, gold, copper?
Yeah. I mean, same. So, a lot of those individual names have had very, very good runs as well. There I would say even a bit more exposed, right? Because some of those jurisdictions, you're not sure. There's safer jurisdictions. There's ones that aren't so. You never know what might happen in those governments there. So again, an opportunity to take some profits. The market cycles work. A lot of it's behavioral. So when you look at market cycles and you start to get that euphoria feeling, and you got that stock in your portfolio, and you don't think you can lose, and that's it. It's a pretty good. You should be saying, hey, let's take a little bit off the table here.
And you mentioned a little bit about geopolitical challenges for the mining too, but also what we saw, the strike in Venezuela on land, what's going on in Russia when it comes to oil and that. Any thoughts on that?
Oil is a tough one, right? It's really driven by that geopolitical right now. Prices are fairly low. I think that's positive for the inflation story. There might be some, as you mentioned a bit earlier, concerns about China and their consumption. So, we're kind of waiting to see on oil. It is a commodity. We tend to prefer other businesses with more recurring revenue, steady subscription-based businesses. But there's always an opportunity to potentially look at it. But right now, we're not loading the boat, so to say, on oil, right?
Okay. Well, we'll leave it there, Richard. Thank you very much for joining us. All the best in the new year. Happy New Year to you.
Yeah. Thank you, Roger.
And that was Richard Orell, Portfolio Manager at RN Croft Financial Group. Coming up, CTV's Judy Trin looks back on the year in Canadian defense spending. That's next. Gander Social, a Canadian-built, values-driven social media platform, raised $1.5 million this month and is moving toward a $2.5 million maximum offering that will be available until the end of January. For more on the Canadian social media app, we were joined earlier by its co-founder and CEO, Ben Waldman.
What our aim is here is to do something different, move away from the manipulation that has driven social media over the last decade, and deliver something that's new and doesn't, use people as the product.
And how are you going to do that? What's going to make you different?
So first of all, one of the things we're doing is we're a small company. You saw what we've raised so far. We're at 1.7 million right now. That is not Facebook money. So what we've got to do is we've got to be scrappy about it. And so rather than try to fight, bots and trolls through AI and, a massive moderation team, we've chosen to go a different route and detect whether people are human or not from the outset. So basically to do verification that a user is human, if they're going to post, if they're going to comment, if they're going to chat, and in ways where we're not storing people's personal data. So that's the main way in which we're aiming to sort of keep out some of the more nefarious users in social media. And then other things that we're doing is when someone posts news, you'll be able to post news, unlike on Facebook. On Gander, you'll be able to post news. However, that's going to come with a media bias and fact check alongside it so that users can actually see where someone's content is leaning and how well it's fact checked.
Oh, hi, it's Paul Harris, Ben. So is that what you mean when you say it's value-driven, because you're trying to think about it very differently? Maybe you can speak to that specific word that's used in your stuff. And the other thing is it easy in this environment to raise money for something like this? Or can you maybe talk a little bit about that part of how that raising money for a small company like yours? Maybe you can give some insight into that. Yeah,
sure. So as far as the values side of things, part of the things, something that we've seen over the last little bit is, we have laws in Canada. We have a charter in Canada. The laws are not respected on a lot of the major platforms, and so we aim to make sure that our local laws are enforced in Canada. And once we get to expanding, the same thing there. The other part of the values here is to make sure that this is accessible to people, to make sure that, we're doing things like I talked about, protecting users from misinformation, disinformation, from bots, trolls, etc. As far as the raising money, it's funny, when we started this out, we went down the VC route, starting to speak to early investors. And what we found was that finding alignment was difficult. And understandably, in a competitive market like social media, people are looking for that unicorn that's going to grow fast and what's the exit. And that's not really what we're doing here. We're a benefit company. We've incorporated in BC as a benefit company, so we're tied to a mission for public good and profit. That doesn't appeal to everybody, and not everybody is that kind of investor. And so we ultimately realized that the Canadians who are supporting us and who are interested in this and something different, those could be our best partners in this. And so that's why we've chosen to go with equity crowdfunding for now. And maybe social impact investment will happen down the line. Who knows?
And how many people have you had invest so far?
I think we're nearing, and don't quote me, but I think we're nearing like 2,200 people right now. The investments are anywhere from $255. We've seen people on average around $8,000 or $10,000 on average. I mean, there's many people at $255, and then a few at $35, $50, that kind of thing. Yeah.
So Ben, I mean, I assume that you're like other social media platforms, your kind of revenue will come from advertising. Is there other kind of ideas that you guys have to increase revenue, or?
You would assume wrong.
Oh, okay, well, that's good.
So we feel that part of the reason that this direction that social media has taken is specifically in order to drive ad revenue as its main mechanism of providing revenue. And that means more eyeballs. It means algorithms that keep people addicted to hate, to division, to dopamine, and all of that. And so we're taking a different tact. We're not pursuing advertising, certainly not as our main means of revenue. We're using a subscription model for additional features for role-based usage of the platform. So if you're a business and you need multiple users and administrators on there, you may pay for that kind of thing. And then this is, without boring everyone, a decentralized network, and which means that other users and organizations can have servers on this network in order to keep their own data, in order to manage their own users, and that is really interesting to us as a means of not only growth, but also as another way of generating revenue, where we would be able to work with governments, universities, down to NGOs, small businesses, ultimately, to provide people with what we're calling a wingspan, which is our social cloud service. So that will be another arm of revenue, and we're experimenting with some other things as well.
Okay, we're almost out of time, but just quickly, when do you have you launched? Have you soft launched? When do you hope to go public with it?
Yeah, so we're early in our beta right now. We've been the team has had it in their hands, and now we've expanded that to some friends and family. We're ironing out all the bugs. We literally just added the chat to it this past couple days, and there's 36,000 people who are all waiting to get on this platform. There's 10,000 who want a beta test. So we're starting that process in the new year of getting everyone on there to hopefully hit the 36,000, 37,000 people on the platform for mid-end of March.
That was Ben Waldman, co-founder and CEO of Gander Social. Well, if there was one word to define 2025, it would likely be tariffs. We'll take a look back on the year that was full of them. Well, probably one of the words we used more than any other this year, tariffs. CTV's Mike LeCouture has this report on the threats and taunts over tariffs that took over 2025 and triggered a trade war.
We don't need their cars. We don't need the other products. We don't need their milk.
It was the opening salvo in the year-long trade war. Threatening to take Canada by economic force, President Donald Trump floated punishing tariffs on his first day in office.
We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
They applied to all goods not covered by CUSMA. The day they took effect, Canada hit back.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods.
Provinces also joined in the fight, removing American alcohol from liquor stores and threatening to cut off energy exports to the U.S.
The next Prime Minister of Canada, Mark Carney.
After campaigning on going elbows up in the face of Trump's tariffs, Prime Minister Mark Carney went to D.C. a week after the election, looking to reset the relationship. In that Oval Office meeting, the Prime Minister did push back on talk of Canada becoming the 51st state.
As you know from real estate, there are some places that are never for sale. And having met with the owners of Canada over the course of the campaign last several months, it's not for sale, won't be for sale.
The two met again at the G7 in Kananaskis, where they reportedly set a 30-day timeline to get a deal done. But the pathway remained the problem.
I've always been a tariff. It's simple, it's easy, it's precise, and it just goes very quickly. And I think Mark has a more complex idea, but also very good.
Over the summer, Canada responded to Trump's complaint about the digital services tax by removing it. While talks continued, so did the threats and uncertainty for businesses.
You guys are about as dumb as a bag of hammers for doing this.
And when the company that makes Crown Royal whiskey moved work at a bottling plant from Ontario to the U.S., Premier Ford didn't hold back.
So this is what I think about Crown Royal. That's what they could do. And I think everyone else should do the same thing.
With trade talks slowing, another Oval Office meeting took place in October, where Trump spoke glowingly of Carney and Canada.
I would think he's more popular now. He's a good man, he does a great job, and he's a tough negotiator.
So then what's holding things up? If he's a great man and you want to do a deal with Canada, why aren't you?
Because I want to be a great man too.
But that laughter would fade after Ontario released an anti-tariff ad in the U.S., using a speech by former President Ronald Reagan. Trump called it a hostile act, while his ambassador to Canada described it as election interference.
A foreign government running political ads in the United States during election season is unprecedented.
Carney would apologize to Trump at the APEC summit, and weeks later, the Prime Minister downplayed how much or little he communicates with Trump.
Who cares? I mean, it's a detail. It's a detail. I spoke to him. I'll speak to him again when it matters.
Those words got this response from Conservative leader Pierre Poilievre.
All of us on this side of the House care about the communities that are being emptied out in our forestry, the steel workers in Hamilton who don't have jobs to pay their mortgages. We care.
Carney, Trump, and Sheinbaum had a 45-minute meeting after the FIFA World Cup draw. In the same week that Trump mused about letting CUSMA expire, he also agreed to keep working on the trade agreement.
Canada makes a lot of things that we don't need because we make them also. But we'll work it out.
The following week, Canada's envoy to D.C. announced she would be stepping down in the new year, saying it was time.
Our discussions with the United States with the CUSMA review, the Canada-U.S.-Mexico Trade Agreement review, that's going to start up in the new year. And I think it's important that we have someone in place that is going to be here through the conclusion of those discussions.
The formal joint review of CUSMA is scheduled for July 1st, 2026, setting up what could be another year of turmoil with our largest trading partner. Mike Lecouteur, CTV News, Ottawa.
Okay, coming up, the opening bells. All right, time for the opening bells at the NASDAQ. Corgi is ringing in. They are a wholesaler for toys and other similar items. And at the New York Stock Exchange, Girl Rising and Cheese the First celebrate their upcoming merger in 2026. They help out girls around the world. And time now for the first 15. This is BNN Bloomberg, and trading is just getting underway. Let's check in on the equity markets and see how things are doing. Well, you can see the TSX looks like we might be in for a bounce back. Are we going to get that Santa Claus rally? We'll have to see. But right now it's up 0.37%. And the S&P 500, NASDAQ pretty much washes right now as they await the Fed and the minutes from its December meeting. Now, looking at some of the movers right now, Freeport-McMoRan is rising 1.9%. McMoran is rising 1.9% as copper headed for the longest winning run since 2017. It's a December rally as well that's been powered by the prospect of more stress in the supply chain. T1 Energy is climbing 5% after the solar equipment manufacturer announced the completion of a $160 million sale of Section 45X production tax credits. Well, gold surged in a record-breaking rally in 2025. We look back on what drove that in the Bloomberg Doc of the Week. Well, gold has surged in a record-breaking rally tied in part to eroding confidence in the U.S. dollar. We look at what is driving its rise and what it means for the global financial system in this Bloomberg documentary.
Metal is having a moment. Not this kind, though, sadly.
Gold hits another record.
Spot gold prices have climbed above $4,000 an ounce for the first time.
The key word is scared.
During times of economic and political and financial turbulence, you buy the dollar, you buy US Treasuries, you seek safety.
Not so much now. Now you buy gold.
What we're seeing at the moment is not like anything really that we've seen over the last couple of decades.
In October, gold extended its already furious run from last year and showed few signs of abating.
This gold rally really looks unstoppable at this time.
Excitement is evident online, on shopping streets, and in capital markets.
Just gold, gold, gold the whole time.
Chinese mining company Zijin Gold recently raised $3.2 billion in one of the year's biggest IPOs. But it's not just a gold rally. Look at silver. In October, it reached its highest price per ounce in more than 4 decades.
I think it is a warning sign that people are very anxious.
Gold is the ultimate safe haven asset, a heart rate monitor, if you will, the health of the global financial system.
And because of that, when you see a spike in the gold price, your first question should really be what's gone wrong.
Gold is the ultimate precious metal. It's been around since the beginning of time. Gold has seen it all and has survived through it all, and it probably will continue to do so.
Because it's reliable, easy to trade, and high value, despite lacking the intrinsic utility of a semiconductor or shipping container full of these things.
Gold has outperformed equities. It's outperformed almost every other asset class if you take your starting point at 2000.
It is the one asset that does very well when the typical parts of your portfolio go down.
It breached $1,000 during the global financial crisis, $2,000 during COVID, and $3,000 after the Trump administration's tariff announcements, which perhaps was a wake-up call.
The dollar for many, many years has been seen as the haven of the market because people trust the U.S. government and they trust dollar assets.
Welcome to 2025.
The dollar is the single biggest decline in 6 months in 50 years. Gold is at record highs.
And here's what that looks like. This gold line, because why would it be any other color, shows how much the metal has increased in value since January. The green line shows the dollar's depreciation over the same period. That discrepancy reflects what's called the debasement trade.
It is the idea that faith and trust in the dollar is no longer what it once was, so you have investors looking at other assets.
People do that trade when they are losing their confidence in traditional government bonds and fiat currencies.
And in that situation, gold becomes quite appealing because there is no counterparty. It's just you and your gold.
It's independent from the government's influence as well.
Which is no longer something investors automatically say about the dollar or the US central bank.
So the Federal Reserve has long been seen as kind of a bulwark of global financial stability. It has cherished independence from the political system in the US. Now the pressure on the Fed from the White House and President Trump has thrown that whole dynamic into question.
Am I allowed to appoint myself at the Fed? I do a much better job than these people.
How sustainable is the Fed's position, given the position that President Trump is taking and given the pressure he's putting on the Fed to lower interest rates?
If the Fed is slashing interest rates all the time,
that makes gold more appealing because unlike cash, it doesn't actually obviously yield interest. And so when interest rates are lower, gold becomes relatively more appealing. But on the other hand, you have inflation that makes gold appealing as a hedge.
And inflation's back on investors' minds as Trump's tariffs risk driving prices higher around the world.
So that's kind of a heads I win, tails you lose scenario for gold.
Over the summer, the dollar fell to its weakest level in more than 3 years.
While there are different views on what's behind that weakness, the takeaway is that the US isn't seen as the trusted ally it once was.
But to find the source of gold's rally, we need to look back further than Trump's second term. A pivotal moment for the metal was in 2022, after Russia's full-scale invasion of Ukraine.
G7 countries froze the assets of the Russian central bank that were held in Europe.
That caused many countries around the world to think we need to diversify away from the dollar in order to shield ourselves against potential or future US sanctions, or at least getting caught up in the dragnet of those.
And by countries, we're talking central banks, which have been steadily adding to their gold reserves. In the early 2000s, they were selling a few hundred tons into the market every year.
They've flipped that now. They're buying about 1,000 tons a year.
And for the third year in a row in 2024, according to the World Gold Council. China, India, Poland and the Czech Republic have been among the biggest buyers.
China in particular has been probably the most important central bank buying gold over the last couple of years. It's the biggest consumer of gold in the world, it's the biggest producer of gold in the world. Really, gold is a China story.
People's Bank of China is trying to create, or at least help to facilitate, a world that's less dependent on the dollar. And one way of doing that for the PBOC is to reduce holdings of the dollar, such as the US Treasuries, and buy gold instead.
About halfway through the 20th century, the dollar became the world's reserve currency. If you want oil, you use dollars. If you want gold, you use dollars. If you want to exchange currencies, often the dollar sits in the middle of that transaction.
Even most of China's exports are settled in the dollar rather than the yuan.
The dollar made up nearly 3/4 of the world's foreign exchange reserves in 2000, but its share has been slipping since then. Pressure on the Fed, with tariffs, inflation and sanctions in mind, it's prompted trading partners to look at the US and its currency in a different light.
People are concerned with geopolitical tensions, with trade conflicts, and Trump's chaotic tariff policies.
And again feeds the idea that why is the world settling trade in dollars? What alternatives do we have?
Demand for gold's also been boosted by gold-backed exchange-traded funds, or ETFs, which let investors bet on the metal's price without ever holding any.
Maybe they don't have access to buy gold bars or to buy physical gold, but they have this access to ETFs.
September was the biggest month of inflows that we've seen in more than 3 years.
We saw that ETF inflows were 6 times larger than what a rates-based model predicts.
And remember, this trend doesn't just concern the precious metal King Midas once mistakenly transformed a daughter into. Although he shouldn't be that upset, she'd be worth a fortune right now.
Platinum and silver this year have rallied a lot more than gold.
Now there's a nuance that can get lost in the discussion about precious metals other than gold.
They're also useful. They're used in industry, they have real sources of demand. So those markets function a little bit differently than gold, but they tend to do really well when gold does well. It's partly about this debasement theme where people are worried about the ability of many developed economies to pay back their sovereign debts. And because of that, they're looking to other precious metals like platinum, like silver, and they're looking to cryptocurrencies.
Gold and to some degree Bitcoin, they are ways to express an opinion that the system itself is going to have some problems.
When it comes to haven assets, the gold standard remains, well, you know.
This gold rally speaks to the times we are living in.
Not everyone's convinced currencies and bonds are so easily replaceable. A major de-escalation of Trump's tariffs or a peace deal between Russia and Ukraine could also spur a price decline. Volatility is very much still in gold's fine print. Still, Goldman Sachs and Deutsche Bank both say they expect gains to continue for now.
With any rally, it naturally makes people worried. Is this a bubble? Is this going to pop soon? One thing it does have going for it is that the secular trends that have been supporting it over the last few years are still very much there.
It's clearly a very fragile geopolitical moment. Old alliances are being tested, new alliances are being formed, and I think as long as these really steep tensions do persist, then that clamour for safe haven assets such as gold is going to continue.
Yesterday on Market Call, we were joined by Brianne Gardner. She is a senior wealth manager with Velocity Investment Partners at Raymond James. She was covering Canadian and U.S. large caps. Her top picks were WSP Global on the TSX, Costco on the NASDAQ, and Broadcom, it's AVGO on the NASDAQ as well. Today on the show, we have Mike Philbrick. He is CEO of Resolve Asset Management, and we'll be taking your questions on exchange-traded funds. Coming up after the break, we'll take a look into Canada's housing market performance this year and the trends for 2026. That's next. Well, this year, Canada's housing market has faced the impact of tariffs, ongoing socioeconomic challenges, and even saw a new federal leadership. But will 2026 be a reset for the housing market? Let's get more on this from Philip Soper, CEO of Royal LePage. Philip, thanks as always for joining us.
My pleasure.
This year, I mean, tariffs was probably the word of the year for Canadians. What kind of an impact did that have on the housing market?
Our research showed it was the single biggest drag on housing activity. The interest rates moved from being a barrier to entry to being either neutral or even supportive. Employment was stronger than we anticipated. Generally, economic conditions were supportive. Yet you go out to consumers, you ask them, how are you feeling and what is bothering you if you're not making major decisions like automobiles or housing. Mm-hmm. And it was trade.
And do we know a number on how much it might have dragged things down, or is it just something that we know it had an impact?
Well, if you look at what the market should have done, given the other economic drivers, we're probably looking at 2 to 4% impact on home prices. And it simply was, home prices hung in there remarkably well, even in our most expensive cities like Toronto and Vancouver, but activity levels were very low. And when you have demand at lower levels and supply healthy, you're going to see slippage in prices, and that's what we saw in our two major markets.
And what other factors were driving it? I mean, we saw a population decrease for the first time. Was that an issue as well?
Yeah, the drop in immigration, temporary foreign workers, foreign students really impacted the condominium market, and particularly in larger cities. The individual investor supplies a lot of our rental stock in big cities. When interest rates peaked or mortgage rates peaked during the inflation spike post-pandemic, it made the math for small investors in rental stock, condominiums, just not work. They should have come back in 2024 and 2025 as interest rates declined, and they just didn't have at the rate one would have expected. And a big part of that was their clients, their tenants disappeared with the much smaller quotas on temporary Canadians or new Canadians.
Now, heading into 2026, are we going to see movement across the board, or will there be areas that may see improvement and some that will still stall, like condos?
Yeah, overall, we're seeing prices up next year by a small amount, just over flat, 1% in aggregate across the entire market. Detached homes higher than condominiums, detached homes in aggregate nationally up 2%, condominiums down 2.5% in our forecast, but very different looks in different regions of the country. We're seeing continued softening driven predominantly by the condominium sector, but not exclusively, in Toronto and Vancouver, whereas home prices in most of the rest of the country are expected to grow modestly. What I've been seeing over the last couple of years, you could actually go back to the end of a pandemic housing boom in 2020, the beginning of 2022, is compression, where our modestly priced cities have been easing upwards in home prices, home values, whereas our two most expensive greater metropolitan areas, Greater Toronto, Greater Vancouver, have been declining. So we're seeing that huge gap that has opened up over the last decade, starting to normalize somewhat.
And is this more of a balanced market? Can we call it that?
Yeah, you know what? When you don't see home prices changing at above 5%, which is the long term, 50 to 75-year norm for house price appreciation in this country, you're looking at balanced markets. And if you look at other indicators, the ratio of sales to homes listed for sale, they're in that balanced territory. In general, it's not a bad time for homeowners. They're not seeing that 5% appreciation, but they're also not seeing a material decline in the value of their homes. And if they are trading up, obviously, if there's a little bit of a difference between what their home is worth and what it was worth, that's going to show up in the home they purchase as well. The big difference is that it's a more supportive environment for younger families, for first-time home buyers. They can add conditions into a deal, and home prices are softer, both in suburban and urban areas of our most costly cities.
And we're almost out of time, but I just want to ask quickly, the government, there was a lot of talk with the new government about homes and helping in that. What do you see happening over the next year when it comes to the government involvement?
It needs to be multi-level. It needs to be municipal, provincial, and federal. All levels of government in most regions of the country are saying the right things. The new federal government's policies are supportive and thoughtfully integrated across all the elements that drive housing. The proof will be in execution. Okay. Can we move policy ideas into actual shovels in the ground, increasing supply and providing that affordability lift for young families?
Okay, we'll have to wrap it up there. But Philip, thanks as always for joining us. All the best for the new year.
You too.
Philip Soper is CEO of Royal LePage. Coming up, we'll take a look at some early market movers on the TSX, including Aya Gold and Silver. And Know Your Options is back. Tune in tomorrow at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. You can email us your questions at knowyouroptions@bnnbloomberg.ca. All right, time now to check in on the equity markets, and let's start with the TSX, and you can see it's up ever so slightly. I mean, that's being optimistic, really pretty much a wash right now, but you can see we're looking at the TSX financials. It is up 0.07%. So it's on the positive after what's been a bit of a struggle over the last few days for the TSX. It's bouncing back a little bit. Heading over to energy, I think you'll see some more interesting numbers here. It's up 0.46%, so it's up as well. That's being fueled by what's going on in the markets right now with gold and silver. And when we head to materials, this is where some of the movers and shakers are today. You can see it's up by 0.83% on the reaction to what's happening with the precious metals, copper as well. And so we can look at some of the individual stocks that are moving right now. And we'll start with Aya Gold and Silver. And it's benefiting on that silver crush. right now. Everybody's loving silver. You can see gold is up by 1.35%, 78, almost 79% for the year. And that's because of that run that gold and silver have had. Heading over, Equinox Gold, you'll find a similar story unfolding. It's up by 1.8%, and it also has jumped for the year. It's up 163.4%, all on what gold is doing. The miners are winning as well. And oil mining, let's continue with this theme. And you can see it's up by a little over 1% and 138 for the year. Again, these are all being driven by what's unfolding with gold and silver, especially silver right now. Silver's bouncing back even more. One more we want to look at from the positive side, and that's Vizsla. And again, it's up nearly 2% and up 206% for the year. Some of the laggers, though, let's have a look. Pet value. I guess there's no gold there. So, yeah, you can see it's off today by 1.2%. Aecon as well, also taking a bit of a hit today. The construction company, we're looking at it. It's off by 2.5, almost 2.5%. Shopify, it has been up and down a little bit lately, and you can see it's off by 0.87%, but again, still up 46% for the year. One last one we want to look at, Gibson Energy. And you can see it is off by 1.4% and barely up for the year, almost a wash. And just a quick look south of the border, we'll look at the NASDAQ and the New York Stock Exchange. They're all in the green right now, but barely. It's pretty much a wash. We are diving into how artificial intelligence is reshaping Canada's manufacturing supply chains with Han Yin Chen, co-founder and CEO of Ascafox out of Montreal, which uses AI to help manufacturers. It's coming up next. And welcome to the second hour of The Open. Let's take a look at some of the stories we are following in the BNN Bloomberg newsroom. Reuters is reporting that China is requiring chip makers to use at least 50% domestically made equipment for adding new capacity. The rule is not publicly documented, but according to people familiar with the matter, chip makers have been informed by authorities they must prove their procurement through tenders. The requirements are relaxed for advanced chip production lines where domestically developed equipment is not fully available. Silver has recovered some of its losses after its biggest one-day drop in more than 5 years. The metal is above a 74 US today, following a 9% slide in the previous session. Gold also edging up after its steepest drop in 2 months. Despite the pullback, gold and silver remain on track for their best annual performances since 1979. And copper is heading for its longest winning run since 2017. The metal's December rally is being powered by the prospect of more stress in the supply chain. Traders have been rushing metal to the U.S. in anticipation of potential tariffs tightening the market for the rest of the world. Futures have rallied by more than 40% this year, setting up the biggest annual advance since 2009. And looking at the markets right now, you can see the TSX in the green after that little slump for the last couple of days, up by 0.22%. South of the border, it's a similar situation. They're almost a wash right now. Now you can see the Dow's back down into the red, but barely, but not much moving there. They're waiting the U.S. Fed minutes coming up shortly. And heading out to the oil fields, what are we looking at right now? WTI is up by 0.29 to 58.36. It starts inching up towards 60 again, but for the year, still off by 17%. And gold, of course, one of the things everybody is talking about. It was briefly back over 4,400 earlier today, but now down to 43.80 and still up by 0.84% for the day, and up for the month, and up for the year. And of course, silver is the other one that we've been tracking, and it is on an even higher trend right now, and it's recovering some of those losses from yesterday. The Canadian dollar, meanwhile, off slightly, but for the year, up by 5.2%. Today, we are diving into how artificial intelligence is reshaping Canada's manufacturing supply chains. Joining us is Hanyan Chen, co-founder and CEO of Askafox, a Montreal-based company using AI to help manufacturers source critical suppliers faster and smarter. Hanyan, thank you very much for joining us today.
Thank you, Roger. Pleasure to be here.
Let's talk a little bit about Askafox. What exactly does it do, and how are you incorporating AI?
So, Askafox, we solve a very practical problem for manufacturers. That is, when supply chain disrupts, they need answers in days, not in 6 months. So we actually use AI models to help them find, qualify, and audit critical suppliers in a very short lead time. So let's take an example. An engineer can basically upload a technical specification of 30 to 50 pages, and AI will give the best recommendation of most qualified manufacturers, including Canadian ones, within seconds, and based on their real capabilities, not marketing claims.
And how does that compare to just an engineer with knowledge that says, well, we need to reach out to this person?
Yes, that is actually one of the key theses of AI revolution is engineers with deep knowledge today. We have a very limited amount for all our manufacturers. But today, AI capabilities can be expanded so that all these factories and manufacturers can benefit from that same deep domain knowledge.
And what models are you using to build this for your customers?
At Askafox, we are a big believer of open models. So basically, we will tune on different models, including Canadian ones, that we want to make sure that our customers get the best experience out of it.
And can you talk about what are the Canadian ones?
So today, there's one thing I think it's very important that people sometimes tend to neglect, that Canada is one of the leading forces in the world in terms of AI development. Actually, it was one of the places that the modern AI emerged. And here in Canada, we have a lot of accessibilities, which are not granted in other countries, for us to get helped and accompanied by those, I would say, R&D institutions. Mm-hmm. And in our case, Askafox, at our early days, we were just building a faster horses until someday that we got introduced to, for instance, a manufacturing institute, and who helped us build, I would say, motors instead. And that experience has been really instrumental in our development.
And are you seeing Canada remain on the forefront when it comes to AI? I'm kind of diverging for a second, but I want to get your thoughts on that.
Yeah, today actually we operate in US, Europe, and also across Asia, and we see something which is kind of puzzling, is the adoption of AI in our manufacturers actually stagnates. I think that's for a reason. I think for decades, Canada has really enjoyed a very relatively stable development course, I would call geopolitical stability resources, which I think reduced a certain urgency of investing in technology if we compare to the other parts of the world where the competition is much more fierce and companies are driven to make more out of those investments. But I think Canadian companies now have come to a realization that the productivity is absolutely the key issue, and AI is here to help. So that's definitely positive on the trend of Canadian companies adopting that.
And has that been driven by the trade war, do you think, with the U.S.?
Absolutely. In our very specific case, since the COVID, the supply chain disruptions is no longer exception. It's becoming the new norm. And as a manufacturer, basically you have two options. Either you think you can predict every uncertainty, mm-hmm. or you can try to build a very solid yet credible plan B, thanks to the technology. So that is why here in AskFox, we often say that when predictions fail, options prevail. So you don't need to beat the odds. You just need to beat your competitors when disruption hits. Definitely today with the trade tensions with the U.S., the global, I think the logistic shocks, we don't lack motivations to build plan Bs for ourselves.
And talking about how you can pivot quickly when you're using the AI, what about just on a more day-to-day for a company? How can this be utilized?
Yeah, one of the things that we actually noticed is, actually, last 2 decades, the global supply chain actually worked. That is why companies, not only in Canada, felt less in need to invest in technology or to build plan Bs, because no one wanted to going through the hassle, like we said, to change partners. But as what we see today, the global supply chain disruptions are becoming operational resilience issues rather than optimization center. Mm-hmm. So that is being said, the companies, they are no longer reluctant in investing on maybe the dollar price of the product, because whenever there's a disruption for 6 months, let's say a factory slows down or assembly line close, the hidden cost is much more important. That is why we have seen Canadian companies shift to local Canadian manufacturers that they didn't even know existed. That was, if you were asking, why didn't they bother asking around? Because once again, they didn't need to. The global supply chain worked for 2 decades until last 3 to 5 years.
Okay, Hanyan, thank you very much for joining us. We appreciate it.
Great pleasure to be here.
Thank
you for the invitation.
Cheers, thank you. Hanyan Chen is co-founder and CEO of AskFox. Coming up, Lindsay Biscaya, it's like I've never heard of her. Lindsay Biscaya hosts a special roundtable discussion on the commodities that made news in 2025 with BNN's Andy Bell and Bloomberg's Derek DeClue. Stick around.
Hi there, I'm Lindsay Biscaya, joined by BNN Bloomberg's Andy Bell and Derek DeClue, executive editor of Bloomberg News Canada, for a little conversation about year-enders, what's been making the news this year. And of course, you can't really end 2025 without talking about commodities. We saw some interesting runs this year when it comes to gold, silver, even copper. But oil prices were a big topic of conversation as well. Derek, we started at the year thinking maybe oil prices would be higher. But it's interesting to see what's happened with oil prices throughout the year and the drop we've seen.
That's right. I mean, I would have at the start of the year thought that, with Trump going into the U.S., very sort of pro-growth economic policy, tax cuts and all that sort of thing, that you might see a bump. But we're ending the year with prices being very, very soft, and it's really a supply story. Russia just shipped the most oil in a week as they have any week since the invasion of Ukraine. They are, and people may not like that, but, India is there to buy it. China is there to buy it at a large discount. And then you have other suppliers sort of, coming on stream. I mean, Guyana is filling up an oil tanker almost every day. They didn't used to produce oil at all. So you have all these sort of factors. Canada, too, is adding to the production mix with the Trans Mountain Pipeline, being able now to ship oil to Asia. So there's a lot of supply out there, and that's the reason that we're seeing what we're seeing currently, which is prices, West Texas Intermediate kind of around where it was 11 years ago. It's hard to believe.
That's what's interesting is more countries seem to want to get into the game, like Canada included, in terms of producing more oil and selling it. But there's also talk about a supply glut in 2026.
Yeah, and OPEC apparently, and the Saudis essentially just changing their game plan, deciding, nope, we can't afford to lose market share in the long run, and going for broke, opening the spigots and increasing production despite this weak oil price. It really indicates that they are concerned about losing their grip on the oil market in the decades to come, and they're willing to forego so much revenue in terms of a higher oil price. To be pumping away with oil well below $60, it fell below $60 late in 2025. It indicates that the world is pretty well supplied.
On the flip side, gold saw quite the run this year. Andy, I'll start with you. Gold, silver as well. I mean, what do you make of what you saw this year?
Disturbing, really. Because it's great for the gold bugs, and they've been proved right. But when you see people buying something that is not money, that does not pay interest, and that is a hassle to hold in the physical form, it does. I think it's a little disturbing in the sense that you hear people are losing confidence in G7 wealthy nations because of rising debt loads. Even gold is meant to be an inflation hedge. Inflation has, to a large extent, been conquered. It hasn't been completely eliminated. Of course, it got back to 2%. But I think it's a little worrying when you see gold surging like that. It speaks to fear.
Well, and I think it also speaks to concern about what's to come in inflation, right? You know, one of the features of this year was the president of the U.S. really trying to jawbone the Fed into cutting rates very fast, and the Fed, has cut rates at a more measured pace. But if the idea is that they're going to run interest rates lower than they should be in the U.S., run the economy hotter than it should be, you're going to see inflation, and I think the gold price is a pretty big indication that that's a very real worry out there.
People should remember that gold can be dead money for a long time. It peaked in 2011, and it didn't get back to that level until the end of 2019. So that was about 8 years that gold did not go up. Now, we're at an all-time record peak for gold right now. In the past, gold has been fallow for a long period, but of course, nobody knows what's coming.
And you're seeing, you mentioned people buying gold. Central banks have also been buying up the gold. Not Canada, though.
No, Canada decades ago essentially got rid of its gold reserves, just decided that wasn't the strategy. I mean, in retrospect, doesn't look like a good move. But of course, central banks, in a way, they're not trying to speculate on the value of assets. They're trying to diversify risk.
When we're talking about commodities, I mean, we saw some really big acquisitions this year, particularly in Canadian companies, right? A lot of mining companies. Anglo Tech was a big one that was just almost finalized. The federal government signed off on it. A big company promising to keep their headquarters in Vancouver. Like, what does this mean for the mining landscape in Canada? Is that important that you have a headquarters in Vancouver, do you think?
It's another minor loss. In a way, I thought the government might even have been tempted to block it, but it would have been tricky. The Keevil family, the controlling family, were willing to see it sold out. And we did get the SOP thrown to Canada. The head office will be in Vancouver. But in the past, in foreign takeovers, we've seen guarantees given. And once the corporate lawyers get a look at it, they can be a little fleeting, the actual commitment to these promises. And they didn't move the domicile, the actual location of the merged company or the primary stock listing. And the government apparently had indicated, certainly reportedly, we want you to do that. But they backed down. They couldn't get Anglo American to agree to that.
So what the government did get in the end was some greater assurance around the number of jobs that will be around the head office. But as we have seen in the past, these guarantees are good up until the point where hard times hit. And then inevitably there is some flexibility, and sometimes there's flexibility that has to be given. The thing about this one, though, is that the Keevils, which you mentioned, have controlled the company for ages. They were about to give up control in a couple of years. They were going to lose their multiple voting shares, and so Teck, at that point, would be vulnerable to a takeover anyway. So part of the government's calculation is, who do we want to take it over? And Anglo being sort of a relatively smaller company compared to BHP or Rio is probably, for Canada, a better buyer.
Okay, and then we also saw, that Cenovus Mag acquisition, some more consolidation when it comes to the oil sands in Canada. A concern at all, or do you think this is just something also that maybe needed to happen?
Well, the ownership of the oil sands over the years has gone into fewer and fewer hands. I mean, they're solid companies, but, when you have a quasi-monopoly like that, it's very tough on suppliers to the industry. If I'm supplying services, I'm getting fewer and fewer possible buyers of my services. Obviously, foreign companies have pulled back from the oil sands, and we've seen buyers, notably Canadian Natural Resources, stepping up. But it's turning into a smaller and smaller group of companies.
That's right. I mean, really, you can count on one hand now the number of really big players, and this one just takes Cenovus a little bit bigger. You've got Cenovus, Suncor, CNRL, as you say. And the foreign guys, they've all exited. They've all decided, or not all of them, but almost all of them have decided to take their money elsewhere and try other things. I thought this was a really interesting. Cenovus and Meg were really interesting, like corporate drama and the personalities behind it. The Meg people did not necessarily want to sell. They kind of got forced into it by Adam Waterous, the billionaire who's behind Strathcona Resources. pushed the company into play. And then it was sort of a months-long tug of war that sort of inevitably ended up with the heavyweight, Synovus in this case, winning, but at some cost.
I mean, Meg was arguably in play ever since Husky quite a few years ago made a bid, and then that fell apart, and Husky itself ended up being swallowed. So Meg was going to be taken over probably sooner rather than later.
Okay. Yeah.
And if there was a logical buyer, for Meg, it definitely was Synovus.
Yes.
They're going to be able to get a lot of cost out of it and make it a more efficient operation.
Okay, we'll end the conversation there. Thanks to both of you. Appreciate that.
Thanks.
And stay with us. We'll be right back.
"2025 for Canadian sports fans was a year of historic wins, deep playoff runs, and national pride. John Benavalli-Rao recaps this memorable year.
Whether it was on the ice or the baseball diamond, this year's biggest games all seem to involve a Canadian team taking on an American rival in a year where geopolitics added to the drama. And nowhere was that more on display than at the Four Nations Cup in February. Can you see? Ahead of a Canada-US game, fans booed the Star-Spangled Banner. It all came amid Donald Trump's tariff threats and involving teams that are longtime rivals.
We're going to drop the gloves right away.
A fight broke out moments after the puck was dropped, and then another and another. 3 fights in the first 9 seconds of the game, which Team USA would go on to win. The two teams facing off again in the final. And in overtime, Team Canada coming out on top. A win celebrated across the country.
They were always going to get it done. I had no doubt in my mind.
But just a few months later, another Canadian team would try for an even bigger feat to bring the Stanley Cup back to Canada for the first time since 1993. The Oilers besting the Golden Knights to go to the Western Conference Finals. And then advancing to play the Florida Panthers for the Cup for the second year in a row. Fans around the nation getting behind them.
Out in front, score!
The Oilers winning Game 1, but Florida tied it up in double overtime in Game 2. Stressed out Oilers fans posting images of their high heart rates while watching. And in the end, the Oilers lost the series in Game 6. The Panthers, Stanley Cup champs once again.
Obviously, we're disappointed with the result. It's not what we wanted.
Another Canadian team that started to get attention around that time was the Blue Jays, who'd finished dead last in their division the year before, but started to rack up the wins, and by July were on top of the American League East.
And a drive to deep left field.
And on the last day of the regular season, winning their division. Something the Jays hadn't done in a decade. In the playoffs, they first faced the Yankees.
Deep left field.
The Jays winning in 4 and spawning this viral moment.
The Yankees lose.
Up next, the Mariners. A battle that saw thousands of Canadians cross the border to cheer on the Jays in Seattle, where leadoff batter George Springer was hit by a pitch in Game 5. As he hobbled off the field, some Mariners fans were heard cheering.
And a swing and a fly ball.
But then in Game 7, the Jays trailing 3-1, it was Springer who crushed a 3-run homer, the Springer Dinger, that led the Jays to the World Series for the first time since 1993. This, the reaction on the streets of Toronto.
This is absolutely monumental. We needed this, Canada. We needed this.
The Jays seen as the David to the Goliath LA Dodgers, who were seeking back-to-back championships with the help of superstar Shohei Ohtani, a series that had it all.
To the bottom of the 15th.
From a nearly 7-hour game that lasted a whopping 18 innings.
It's grounded to second.
To an epic finale, Game 7, considered one of the best baseball games of all time, that went 11 innings. and saw the Jays several times come within inches of winning it all. But in the end, the Dodgers came out on top. For Jays fans, a crushing defeat, but hoping the team will make a return to the World Series in 2026. John Benavalli-Rao, CTV News, Toronto.
Coming up, headlines from the BNN newsroom and a look back on Canadian politics. Reuters is reporting that China is requiring chip makers to use at least 50% domestically made equipment for adding new capacity. The rule has not been publicly documented, but according to people familiar with the matter, chip makers have been informed by authorities that they must prove their procurement through tenders. The requirements are relaxed for advanced chip production lines where domestically developed equipment is not fully available. Shares of Meta are rising today. The tech conglomerate has agreed to buy Manus in a deal valued at $2 billion US. Manus is a popular Singapore-based artificial intelligence agent founded in China. The transaction marks a rare U.S. acquisition of an Asian tech company. A Meta spokesperson has said there will be no continuing Chinese ownership interests, and Manus AI will discontinue its services and operations in China. Shares of Frontera Energy are rising today, up 1.62% right now. The energy company has entered into a $120 million prepayment and commercial agreement with Chevron. The Calgary-based company will commit to deliver a portion of its crude oil production for 2 years to Chevron. Frontera says the agreement is replacing an existing prepayment agreement which expires at the end of January. And taking a look at the markets quickly, you can see it's a mix. Probably best described as the TSX being led by miners, up by 0.18%, and south of the border, kind of flat. S&P 500 off by 0.13, NASDAQ down by 0.15. Well, it was a fast food frenzy that was anything but. Long drive-through lineups at a newly reopened Taco Bell have slowed traffic for days, forcing Mount Pearl to step in with traffic control in Newfoundland. CTV's Garrett Berry braved the pouring rain to find out what exactly has gotten consumers so excited and who is being left out.
A parade of red brake lights have taken over this stretch of a major thoroughfare outside of St. John's. Cars lined up down the street for a third day running, waiting for a Taco Bell meal.
Delicious. Hopefully it tastes as good as they say.
How long did you have to wait?
Half an hour.
Not too bad.
1:30, 1:58 now. Got the food.
Since 1:34.
Since 1:34. Do you think it's going to be worth it?
Definitely. It better be.
It's just something different, something we haven't had in a long time. It was here a couple years ago, came and gone, but nice to have again, see?
No, it's not the first time the restaurant has come to this province, but this reception has been staggering. Over the weekend, some reported waiting hours just for a taste.
My son's birthday's New Year's Day. He wanted some. The lineup seemed pretty good today, so I said, okay, I'd get in the lineup for him to have a try.
The city of Mount Pearl has been forced to implement some traffic measures to help manage this lineup. They've banned left-hand turns in or out of the Taco Bell restaurant itself. They also have enforcement officers down here in the lineup trying to smooth things along. One job, ensuring people can get in and out of this nearby funeral home. The dining mania hasn't spilled over to other area restaurants, and not everyone is a huge fan of the drive-through craze.
Disposable dining dollars are at a premium more now than they've ever been.
Restaurateur and industry advocate Todd Parent says the local independent restaurant scene is simply in competition with some of these fast food giants.
We're in a world where the public needs to decide what kind of communities they want to live in, and if they want to live in fast food, franchise-dominated, cities and towns, then they get ultimately the customer gets to decide.
He hopes that these dedicated customers remember businesses like his, especially during the slow winter months. Garrett Berry, CTV News, Mount Pearl.
Okay, 2025 came with a lot of political change. It started with Prime Minister Justin Trudeau resigning and ended with two MPs crossing the floor. All of this playing out while Canada-U.S. relations soured, bringing trade, tariffs, and Trump to the forefront of many decisions. CTV's Annie Bergeron-Oliver reminds us what happened this year in politics.
Just days into 2025, the winds of change were blowing strong as Prime Minister Justin Trudeau announced his tenure was coming to an end.
This country deserves a real choice in the next election, and it has become clear to me that if I'm having to fight internal battles, I cannot be the best option in that election.
The election wouldn't happen until the spring, but Trudeau's plunging popularity with Conservative premiers, his caucus, and eventually the U.S. president had become insurmountable.
Justin Trudeau, nice guy. I think he's a very good guy. I call him Governor Trudeau. He should be governor.
For months, their troubled relationship and Trump's calls for Canada to become the 51st state dominated the political agenda.
Oh, say, can you see?
And even bled into the sports world, where the U.S. anthem was repeatedly booed. The tense tariff war and strained Canada-U.S. relationship, becoming the focus of the 2-month-long Liberal leadership race.
Our neighbors want to take us. No way.
From the start, the former Bank of Canada governor was the front-runner, and in the end,
the next Prime Minister of Canada,
Mark Carney easily won, defeating former cabinet ministers Chrystia Freeland and Karina Gould.
We didn't ask for this fight, but Canadians are always ready when someone else drops the gloves.
The hockey metaphors continued into the federal election campaign that Mark Carney called.
I'm asking for your vote so we can be Canada Strong.
But Canada Strong wasn't the only slogan that took hold.
Elbows out. Elbows up.
This ad with comedian Mike Myers caught the attention of Canadians cementing elbows up.
Elbows up.
As Carney's go-to phrase.
Elbows up.
The 5-week campaign focused almost exclusively on affordability, Trump, and Canadian sovereignty.
Justin Trudeau and Mark Carney and the Liberals have made Canada's economy weak. They are not strong enough to stand up to Donald Trump.
At the start, the Conservatives, led by Pierre Poilievre, were poised to form government. But by the end,
the night before the election, how many of you voted already?
Canadians voted for a slim Liberal victory, 169 seats, including the riding of Carleton that was previously held by Pierre Poilievre. The Conservatives won 144 ridings. The NDP just 7. Its leader, Jagmeet Singh, losing his seat and his political career.
We may lose sometimes, and those losses hurt, it's tough. But we are only defeated if we stop fighting.
Do you think there should be a leadership review?
The election results triggered questions about whether the Conservatives, who lost a major lead, needed a new leader.
Are you worried about a challenge to your leadership, Mr. Poilievre?
No.
Those leadership questions faded slightly over the summer after Poilievre won an Alberta by-election and Carney was accused of dropping his elbows or caving to Trump by repealing some retaliatory tariffs against U.S. products.
His elbows have mysteriously gone missing.
The elbows down saying has stuck around among critics who feel Carney isn't standing up to Trump. One MP who likely disagrees,
a good day for Canada.
Former Conservative MP Chris D'Entremont. The Nova Scotia MP crossed the floor to the Liberals in November, just ahead of a crucial vote on the budget and its $78 billion deficit.
I wasn't feeling that I was aligned with the ideals of what the leader of the opposition had been talking about.
Let's give a warm welcome to our newest member of the Liberal Party.
And he wasn't the only Conservative who felt that way. The night of the Liberals' holiday party, Markham's Michael Ma revealed he was crossing the floor.
Wow, such a big welcome.
Bringing the Liberals 1 seat shy of a majority government. But it wasn't all good news for the Liberals this year. The environmentalist Stephen Guilbeault resigned from cabinet after Carney and Alberta Premier Danielle Smith announced plans to build a pipeline to northern British Columbia.
Very pleased that the Prime Minister has heard our concerns and responded to them.
Questions about whether a pipeline are the right move for Canada now are expected to dominate the political landscape in 2026. And already, some pundits are speculating that an election call could come next year. Annie Bergeron-Oliver, CTV News, Ottawa.
Coming up, hot picks. We'll zero in on 3 plays in software, including sticking to the classics with one of the Mag 7s. That's when we come back. Okay, time for Hot Picks. Our next guest covers software and has one of the pioneers in software as his top pick. Let's get more from Rishi Jaluria, Software Managing Director at RBC Capital Markets. Rishi, thanks as always for joining us.
Thanks so much for having me.
All right, you're going old school with Microsoft. Can we call it old school now?
You know, I mean, Microsoft is one of those really interesting companies that's been proven to be able to reinvent themselves time and time again. Obviously they were, as you mentioned, a pioneer in software, but they really successfully navigated the cloud transition incredibly well. If you look at the momentum they had with Office 365, with Azure, with everything in their cloud suite. And now they're going through that again with AI, right? They were very early to AI, making the first investment in OpenAI back in 2019. And look, they're going down an AI first route, infusing AI throughout the stack. And what I think really impresses me the most about Microsoft, or what makes me the most optimistic about this name, is the fact that I think they have the most amount of ways of benefiting from AI throughout the stack. It's not purely just using the raw compute capacity for training of models, but it's at the data layer with things like Fabric and Cosmos DB. It's at the developer layer with GitHub Copilot, at the application layer with Office Copilot, security layer with Security Copilot. We can even imagine properties like LinkedIn and gaming that are overlooked by investors today becoming material beneficiaries of AI.
So Microsoft, as big as it is, still seems to be able to adapt and lead.
I think that's right, and a lot of it definitely comes down to the leadership of Satya Nadella, who has been very forward-thinking throughout his tenure as Microsoft CEO.
What's he done the most that's impressed you?
I think the biggest thing that I think he's done that I've seen is really double down on innovation, right? The larger a company gets, the harder it is to actually innovate, to come up with new ideas. But he's created this culture of innovation, of almost having a more open ecosystem, a kinder, gentler Microsoft, so to speak, versus what we saw under the Steve Ballmer era, that Microsoft is willing to work directly and integrate directly with their competitors. And I think anything that breeds customer success breeds innovation, and that ultimately breeds company success. And I think that culture that Satya has created has allowed them to be so successful.
Okay, next up, MongoDB.
So MongoDB may not be a household name, but they're a next-gen database vendor. They compete with Oracle, but they're really focused on unstructured data. Think about data that can't fit neatly into rows and columns. And look, the stock's had a great run off the bottom. But what I think makes me the most excited about this one is really, if we think about the opportunity for the creation and development of net new AI applications, especially those leveraging this unstructured data, MongoDB is really well positioned, has the right technology, and I think this can be that developer platform of choice for those AI applications. We're already seeing some of these very hot AI natives like Cursor and Relevance AI using MongoDB, and as those companies become more material, I think that becomes a real tailwind for Mongo.
And what are some of the technologies that you like that they're incorporating?
Yeah, look, I think there's a couple things. Number one is just the ability to work with unstructured data, because working with unstructured data is a very fundamentally different problem than working with structured data, which is where you'd use something like Oracle or open source Postgres. But then I think it's also integrating a lot of these adjacent technologies. You think about things like bringing an Atlas search, a vector database with MongoDB Atlas Vector. Now they're leveraging AI to make it easier to move relational workloads onto a non-relational database, in this case, MongoDB. So I think it's really bringing in all these adjacent technologies onto this core non-relational database and expanding that, because that just leads to greater share of wallet, greater share of workloads. And I think, again, puts them in that position that as we see the development of more and more AI applications, and those applications get scaled, that becomes a real tailwind for MongoDB.
Okay, and last up is HubSpot. What are you liking about that?
Yeah, so HubSpot is, I think, a really compelling company. I almost think about them as the anti-Salesforce. They're in the same spaces as Salesforce. You think about sales, service, marketing, commerce, operations, et cetera. But in contrast to Salesforce, HubSpot is a company that has been built from the ground up organically. So all those different modules that we've talked about are built on the same platform versus through a string of M&A, which is what we see out of Salesforce. And I think this is, again, a company that is really investing in innovation, in customer success. And I see two ways that HubSpot can be a major beneficiary of AI. Number one is I think they have one of the most forward-leaning AI roadmaps in front office application software today. And really that comes down to their co-founder and CTO, Dharmesh Shah, who is probably more hands-on with AI than any public company exec, at least in this market cap range that I've seen. But I think the second thing is I believe they can leverage the innovation that AI brings and accelerate the pace of product development and use this as a way to narrow the gap versus Salesforce, because Salesforce definitely competes in the large enterprise. Just think about the Global 2000, whereas HubSpot tends to be more in the mid-market. Over time, I think that will change, right? If they can use AI on the product development side, create those governance and security and customization capabilities that are necessary, I wouldn't be surprised if we see HubSpot win a deal in the Global 2000 against Salesforce in the next 5 years.
Okay, we're going to have to leave it there, but Rishi, thanks very much for joining us. All the best in the new year.
Thank you so much.
Rishi Jaluria is Software Managing Director at RBC Capital Markets. Coming up, the federal government says it will be introducing regulations for stablecoins in the new year. We'll get more on the stablecoin outlook for 2026 from Jillian Friedman when we come back. Earlier this month, the Bank of Canada's Tiff Macklem said that future stablecoin regulations must be backed by high-quality liquid assets. The governor of the bank saying stablecoins need to be good money, like banknotes or deposits at a bank. However, for those in the industry, many are worried that Canada is falling behind on stablecoin regulation. Here to talk more about it and what she expects for the Canadian stablecoin industry going into the new year is Jillian Friedman, Chief Operating Officer at Symbiotic. Jillian, thanks very much for joining us.
Thank you for having me.
Let's talk a little bit about the year that was before we get into what we might see for 2026. A bit of a rough year for cryptocurrency. Bitcoin's down, and it was up and down quite a bit. What are your thoughts on how the year went?
I think overall it was actually quite a positive year for the industry as a whole. If you zoom out and look just at digital asset prices, Bitcoin is doing considerably better year over year. But really, what I think we should be looking at is how the underlying technology is being adopted and used, and how it's actually adding value and creating value beyond the broader crypto ecosystem. So I would say 2025 was a bit of a breakout year for crypto, because you actually started to see adoption of this technology and this technology being taken seriously by traditional finance and other types of fintechs that aren't necessarily crypto businesses.
What changed? What do you think changed then to see that happen?
Yeah, I think one of the major changes that you really can't look at 2025 without acknowledging the shift in the political and regulatory climate in the United States. That was a major difference in 2025, that previously the regulatory environment in the United States was bordered between ambiguous to outright hostile towards these types of businesses that are building and using cryptocurrency or on blockchains. And what changed in 2025 was really an endorsement and a willingness to create a regulatory regime that provides clarity to builders so that they have the confidence to actually invest in and build products. And the other major change, I would say, or they're related, would be the uptick of stablecoins and the use of stablecoins by businesses and retail users to move money around globally.
And now Tiff Macklin talked about stablecoins and having regulations for next year. What would you like to see? One of the things he talked about was that they need high-quality liquid assets pegged one-to-one to a central bank currency. Your thoughts on that, and what would you like to see?
Yeah, I think most would say that the requirement that the assets be pegged by one-to-one and with a high-quality liquid assets held in custody in bank accounts with financial institutions is pretty middle of the fairway of an expectation. Seems to be consistent with some of the other regulatory regimes that other countries are implementing. And so overall, a positive approach from the Bank of Canada, and frankly, one that would have been hard to predict at this time a year ago. There was a lot of drum beating saying that Canada's moving too slow. We need an approach with stablecoins. Look at what's happening in other jurisdictions. Stablecoins are enabling further and further U.S. dollar dominance, and Canada needs to catch up. And I would say that still is the case, that Canada needs to catch up, but the current approach seems to be setting the stage to allow that catch up to take place.
And now, he also, in that speech, he promised more innovation in 2026. What do you think we'll see when it comes to that, or what would you like to see?
Sure. So I think what we can expect to see is more of a blurring between fintechs and crypto businesses. I think you may be a user of a fintech service, whether you're a business or a retail consumer, and you're using blockchain or crypto on the back end, and that's what's operating on the back end, and you're not even aware of it. And so I think you will just see a more and more mainstreaming of this technology, and that it's being abstracted such that users don't even know that they're really using it. I also think that the regulatory clarity, specifically around stablecoins, is going to enable Canadian financial institutions to more meaningfully first test, but then adopt this new tooling where it makes sense for them. And so those are two areas that we're paying close attention to. And further, we would expect to see a discussion around what happens to the interest or the yield that is generated by the reserves that are backing those stable coins. And so that's a discussion that you're starting to see happen in the United States. It's starting to happen here as well. It hasn't really been addressed by the regulators yet, and it provides a real opportunity for Canada to differentiate itself.
Okay, we're almost out of time, but you talk about, in the report you had, that you would like to see this change from securities to a payment instrument. Why is that so important? You got about 30 seconds.
Because stablecoins are primarily used as payments. And so the regulatory framework that addresses payments would be more appropriate than a securities framework, which makes it much more onerous to freely transfer these assets globally or between different owners.
Okay, perfect timing. Thank you for that, Jillian. We'll have to wrap it up there. All the best for the new year.
Thanks, you too.
Jillian Friedman is Chief Operating Officer at Symbiotic. That wraps up this edition of The Open. Morning Markets with me is up next. It's the holiday.